Have you ever wondered what a mortgage underwriter actually does? This mysterious person who's on the other side preventing you from getting your keys? Well, it's not quite like that, guys. In fact, underwriters are great folks. They're just doing their job. They actually do their job for you to make sure that you're getting a good loan. Today's video, I'm going to dispel all the myths about what mortgage underwriting is, what it isn't. Going to take you behind the scenes about what all that happens in that process, just so you can see what that process does for you. My name is Emmett Dempsey. I'm a mortgage broker and owner of Treasure Coast Mortgage here in Florida, and I help families buy homes. And I'd love to help your family next. If you would, just go ahead and leave a like on this video. It really helps me and with YouTube, let them know that other folks want to see this video. It really helps the algorithm. Also, if you haven't subscribed to the channel, I'd really appreciate that. Go ahead and hit that subscribe. And with all that out of the way, let's go ahead and talk about underwriting. So what is mortgage underwriting? Essentially what underwriting is, it's a risk assessment. And then the risk is you. Are you a suitable borrower? Do you have the capacity to pay back the loan? I'm sure if you loan money to your friend, you want to kind of see if they have a job to pay you back, right? So that's kind of what an underwriter does. They want to make sure that you have the capacity to borrow money and pay it back along with certain guidelines, which are basically the rules. So they have the rules of every loan program, like conventional loans, Fannie Mae, Freddie Mac, FHA, VA. So those are the different players who write their rules that say, hey, if you underwrite the loans to this standard, then we'll buy them. So effectively, that underwriter their job is to assess their risk, to make sure that you're an acceptable borrower to underwrite according to their rules. So that's an underwriter's role in the mortgage process. The ones who assess the risk based on the information that we provided as the mortgage broker to make sure that you fit the rules and that you're an acceptable credit risk. So how does an underwriter assess you? Effectively, they use kind of like a tripod or a triumvirate, whatever three kind of thing you want to say. Basically, credit, capacity, and collateral. So credit is self-explanatory. Your FICO score, I know in the mortgage industry, we use FICO versions 2, 4, and 5. Your score is one piece, but if you have recent foreclosure, bankruptcy, have their own unique rules that they have to follow. For instance, if you had a foreclosure, you generally have to wait 3 years before you get an FHA loan. So make sure you've met the acceptable waiting times. It's kind of what an underwriter assesses. So in that credit box or the credit piece, that's what they're going to assess to make sure that you have a history of paying back credit. So if I'm an underwriter assessing your risk and I look at you have an 800 credit score and you have years of history of paying back loans, that's a very good risk, right? If you have a 400 credit score and you just had recent credit or no credit, it's even worse. So if you have a lower credit score and you have a history of not paying back mortgages, if you have a history of not paying back debts, then that's a bad credit risk and they might deny your loan. The next C is capacity. Capacity basically means your capacity to pay back the loan. If you have no job, you don't have any capacity to pay back a loan. So therefore, that's what's called ability to repay, or ATR. That's the new rules that came into effect with Dodd-Frank after the 2008 crash. So your capacity is how much money do you make? And underwriting guidelines are very specific. They weigh your employment income more than self-employed. Self-employed income is underwritten differently. They look at tax returns. There's other programs that have like bank statements and things like that, but that's something for another video. But essentially, your capacity is your ability, your income that we can document. Okay, number one, we can document documentable income that it can be used to pay back the loan. Again, assessing your risk. Okay, and the next is your collateral, which is the house. Okay, so to make sure we get an appraisal to see what the house is worth based on what other things are selling in your neighborhood, they're called comparable sales. Also to make sure that the house is in good condition, that it's acceptable to rules. Like FHA has certain condition rules above and beyond conventional. They said the same thing with VA. Has certain VA guidelines that has to be livable for the veteran. So that collateral, to make sure that the collateral risk, that it's a good risk to get a loan, that it's insured. So that's the collateral piece of that third C. Okay, so what are the commonly required documents that an underwriter is going to need? Essentially, it's what I've already asked you for up front. So when you first talk to me, I'm going to ask you for a checklist based on your situation. So if you're employed, it's going to be your pay stubs, W-2s, your driver's license, your bank statements, your investment account statements. Or you're self-employed, you're going to need tax returns, and then or business bank statements. If you're doing a bank statement loan, which we do. If you're doing a DSCR loan, the property has to properly cash flow. All depends on what the rules are of the loan that we decided you're qualified for. So all that documentation that we get up front. Before you're even start shopping for a house and you get pre-approved. So that's what the underwriter is going to use to assess your credit risk and to give an approval or denial. So that's why it's very important that you tell me the truth. So when you do your loan application, if there's something you're not telling me, then the underwriter is making an assessment based on incomplete information. So when we go to initial loan application, we try to be as thorough as we can up front before it gets to underwriting. So ideally, an underwriting scenario is very fast. It just goes into underwriting. They look at it, and they can evaluate their 3 C's or however they do things, and they make sure it's a good loan and it's approvable based on the guidelines. And then your loan will spend less time in underwriting, and then you get closer to buying your house. Okay, there's actually 2 different types of underwriting currently in the mortgage business. mechanisms. There's automated and manual. So you might have heard your loan officers say something about approved eligible or AUS or LP, DU, DO, all these different acronyms that are like, what the heck are you talking about, guys? But essentially, those are automated underwriting systems. Fannie Mae uses a desktop underwriter or desktop originator, depending on the channel. And then Freddie Mac uses loan prospector or LPA, whatever it's called now. But essentially, these are algorithms that have been done by these government-sponsored entities to assess risk. Again, risk, if we had to say what underwriting is, assessing risk, that's kind of like, it saves us a lot of time in the video, but I appreciate you watching. So that's what these systems do. They take all the information that's inputted, and then they come up with a recommendation. So approved eligible is what Fannie Mae says, or an LP accept. So it looks at the collateral, it does its own computer system, looks at the automatic evaluation models of the properties around there, and it gives its recommendation. So that's what the automated underwriting is. The vast majority go through the automated underwriting systems, and that's what we try to underwrite you to. If you have decent credit, good capacity, the 3 C's are very good, 99% of the time you're going to go through automated underwriting, and it's going to be a much faster process. And many times you don't even know that. That's what we in the industry use. But if you hear those terms, I got an AUS approval, that's what that means, automated underwriting system approval. There's also some things that we do as brokers that are called manual underwrites. And these are for things that kind of fall outside of the guidelines. Basically, lower FICO scores or something, or your debt to income falls outside of the norms. The underwriter says, wait a minute, I don't just deny the loan or suspend it, where VA is very good for this, and FHA loans are very good for this as well. So I've done quite a few FHA manuals and VA manuals, which is really good because we can do VA loans down to 500. And sometimes there's some questions. You basically, hey, what's that debt? Have you incurred new debt? Have you have a history of, okay, you had some bad credit in the past? Have you have a history of good credit going forward? And then the underwriter kind of uses their own human judgment and not through a computer system. That's what a manual underwrite is. And a lot of times it can save your loan. So definitely ask your mortgage professional. Definitely ask your mortgage broker about manual underwrite. And I know we try and go through automated underwriting first, and then if we can't do that, it's what manual underwriting options are available, and then we do our best to get you approved. Okay, so what are the common roadblocks in underwriting that would have jeopardized your loan? So basically, issues like gaps in employment. There are certain gaps require certain wait times, and then you can't get like an FHA loan. So you need to be very clear on your 2-year history. You need to see if there's any gaps in employment. Another one is child support and alimony that be surprised that people forgot that they have or they get hit with. Student loan debt. If your student loans are deferred, they're not taken out of your debt to income. But we have to assume a payment, even if you're not paying it in real life. And I always joke that there's the mortgage world and the real world, and they're not really the same thing. So the underwriter has to take a payment for your student loans unless it's income-based repayment, and that's another video as well. But essentially, a high debt to income is a pitfall for your loan. And of course, your down payment sources. I've seen basically if you have all cash sitting in your safe or under your mattress, we can't use that because I have to document that. So I have to have, they're called sourced and seasoned funds. So if they're not sourced and seasoned, then I can't use those for your down payment and closing costs or your reserves. So basically, if you plan on buying a house and you do have cash, put it in the bank, let it sit there for 60 days, and so we can, so it would be sourced and seasoned, so we can use those funds for your cash to close. There's 2 very important acronyms that underwriters really risk against. There's LTV and DTI. LTV is the collateral risk, your loan to value, how much are you borrowing versus how much it's owed. How much you're borrowing versus how much the property's worth, or your debt to income. How tapped is your capacity if you're saddled by other debts competing with the mortgage debt. So, loan to value, of course, the more money you put down, the less risk, and of course, the better interest rate. So for debt to income, it's a 0-1 game. It's binary. It's either you qualify or you don't. Essentially, it's really about 50% of your gross monthly income. For instance, if you make $10,000 a month, $5,000 a month is about the high watermark of all your debts plus a new mortgage that it could be. So those 2 acronyms are very important, and that's how an underwriter assesses risk. Okay, the underwriter's gone through their 3 C's and 2 acronyms and all these things, and now we've come to a decision. So what are the potential decisions for an underwriting approval? So essentially, there's what's called approve with conditions. So you might say, I've gotten a conditional approval. All right. So that's kind of the good part. So we have an approval with some conditions that the underwriter has some questions about. And every loan has this. There's very rare that we get what's called a one-touch clear to close. So my wife is actually a processor. She processes my loans. She's done that before because she's super awesome. But it's relatively rare. Most loans do have conditions. And namely, I need an insurance policy. policy, because a lot of times it's not bound before closing, updated title, all normal stuff, and nothing out of the ordinary unless it's something that they find. They'll do like a LexisNexis search. They'll find they found properties that you didn't own, because believe me, guys, if you don't tell me up front, they're gonna find it. All right, so you can't really hide it. The next is suspension. Okay, suspension basically means, wait a minute, we're kind of need to set this to the side, not approved. There's something that could potentially deny the loan that needs some more information. So when a loan is suspended, mainly it's like, hey, I found this debt and it pushes our debt to income above qualifying. Can you pay off some debt? So there's certain things that we try and get it out of suspense, or suspension as we call it, in order to get you back to approved with conditions. And the last is just a flat out denial. Sometimes it's just too much debt, too much collateral, where it just falls outside the guidelines, and the underwriter, we've tried every last which way to do it, and it's just denied. Okay, how important is it to stay in touch with us? It's very important. Again, be very upfront and honest upfront with your loan application. It helps mitigate a lot of these things blowing up in underwriting. And remember, you're in underwriting when you're buying a house. You have spent money. You put down an escrow money deposit. You pay for an appraisal and inspection. You don't want these things to blow up in underwriting. You don't. You want them to be fleshed out before you even look for a house. So communication is very, very vital from the pre-approval process to buying a house, to make sure there's any pitfalls that we can address them up front before you can go into underwriting. Okay, and then your loan is clear to close, and then your loan is CTC, or clear to close. So people get very excited about that. So essentially, what you do is you have a closing date. You'll set by your realtor or the title company. When the seller is ready to close, you wire your funds to title. You walk in and you sign, and then you're a homeowner. So that's the end of the underwriting process, and then the beginning of your home ownership process. Congratulations. So it's very important that you keep your financial stability during the underwriting process. And what I mean by that is, don't quit your job, don't change jobs, don't take a large deposit in or out of your account, and of course, don't do anything major to the property, especially if you're refinancing. You definitely want to avoid any large purchases, because I've had clients that have bought a car. You probably see those memes about buying a car. Large purchases, buying a car that's going to affect your debt to income, one of the risk factors, or of course, changing jobs, your capacity, or doing something to the property, your collateral. So don't do any of those different things, guys, during the underwriting process. So the underwriters aren't bad folks. They're just trying to mitigate risk to make sure we have a sellable loan. So at this point in the video, you probably want to see other videos we have about awesome mortgage topics. YouTube wants you to watch this video right here.